Well, U.S. interest rates are at the highest levels in more than 2 decades overall. And while cuts are expected in 2024, Vanguard economists say the days of ultra-low interest rates are over. So what does this new reality mean for the path ahead? Joining us now with more is Roger Aliaga-Diaz, Vanguard's chief economist and global head of portfolio construction. Roger, thank you so much for being here. So we're talking about rates, we're talking about jobs. I actually want to pick up on the latter first, because you have a forecast for the unemployment rate that is considerably higher than where the Fed is projecting it will go. So talk us through your forecast there and why you are sort of diverging here.
Yeah, absolutely. Yeah, there is a couple of factors here. One of them being, we believe that the cumulative effect of the monetary restriction will eventually exert pressure in 2024. Right, 2023 we avoided the slowdown. There is no signs of a recession, and it seems that we are in the path of soft landing. But that is about to turn in 2024, and that alone will lead to lower payroll numbers and higher unemployment rate. But the second factor is that the labor supply, whether led by foreign-born workers and immigrants, as well as early retirees that are coming back, have make a surprising comeback in 2023. That was a significant increase in the participation rate, and that may mean also that that the unemployment rate may go a little bit higher than otherwise in this cycle. So we were expecting 4-5% by the end of 2024, and now we have upped that to 4-8% as part of this Fed-induced slowdown, which is needed to bring inflation down, right?
And Roger, we have plenty of smart economists and strategists on the show. When they look ahead to 2024 here, they see a soft landing. Is that what you see?
No, not necessarily. I mean, certainly is a possibility. We cannot discard it. Soft landing is an incredibly difficult balancing act, really, to achieve. It has rarely been achieved before, right? It requires basically that the labor market stays strong while the cumulative effect, as I was saying before, of the monetary policy doesn't do much, right? Essentially, we have seen the data coming in support of soft landing because of inflation coming down. But the question that we all need to answer, even the Fed needs to answer, is why the 5%, 5.25% rates are not really hurting the economy. That's something new. Of course, there are many reasons to think about the long and variable lags. We saw the fiscal policy, the debt finance industrial policy in 2023 kicking in very strongly. We saw the labor supply shock I was talking about before. Oil prices behaving incredibly well in spite of the geopolitical risks, right? So all those factors really contributed to that softening in inflation. But some of those factors may turn. Actually, none of these are driven by the Fed, right? And 2024 could be a different picture where inflation, if it comes down, is because the economy is slowing down, which is really the more natural way for inflation to decelerate.
So then if that's the case, Roger, how does the Fed react, right? If maybe inflation is coming down, but not because of them, but at the same time, if we're seeing that unemployment rate tick up, do you think, there's a lot of diverging opinions right now as to when the Fed is going to begin to cut. When do you think that's going to happen?
Yes, I mean, that would push the Fed cutting more towards the June, mid of the year, as they see the unemployment rate going beyond their own forecast for the year. They have 4.1% for the year. If unemployment rates start getting to 4.2, 4.3 mid-year, that's where they may accelerate the cuts.
And Roger, I'm also interested, what do you think the Fed needs to see before they start cutting? I mean, clearly we just saw the minutes. There's some uncertainty about if and when. Is it just, Roger, they need to see inflation come back to 2% and stick there for some amount of time, as well as see the economy slowing?
Yes, absolutely. They need to see inflation in a sustained path downwards. But again, I mean, this is difficult to think will continue without a further softening of the labor market, right? So it's the combination of inflation coming down with unemployment increasing which will actually trigger the cuts by the Fed. What is very difficult to see is what the market is pricing in, right? Because the market is pricing quite a few cuts with no increase in unemployment and with inflation coming down. So in our view, one of two scenarios can happen. Either the unemployment rate increases and the Fed cuts as much as the market is pricing in, or alternatively, you have unemployment remaining at 4%, avoiding recession. But in that case, we don't see the Fed cutting as much, right? So what is really difficult for us to see is this middle ground of more than 5-6 cuts with unemployment at 4% and with inflation coming down.
So if there are these sort of two binary scenarios here, Roger, how do you approach that as an investor? Is there sort of a middle path that will be somewhat agnostic or that can succeed no matter which of those things comes to pass?
Yeah, the way you're characterizing it is really the right way to think about it. It's a bimodal, right? A binary outcome. So the average of both them is not the most likely outcome, right? And that seems what the market is pricing in. It's almost pricing in the middle of the two. In our view, this binary outlook translates into probably volatility. We think that on the one hand, the Fed may need to walk back a little bit the dovish rhetoric we heard in December. The minutes today are a little bit more neutral to that respect. And also the market probably will have to reprice more the Fed path in one of these two outcomes. So I think we're concerned, we're worried about the short term, this financial easing and this exuberance in risk assets. We may see a little bit more volatility as this repricing happen, right? Medium term, we're more optimistic, but in the short term, we're more concerned about this.
Roger, finally, we've been asking investors, strategists, economists like yourself, maybe if you're thinking about New Year's resolutions for investors for 2024, what do you think that folks should be thinking about?
Yes, well, I think we learned a couple lessons through 2023. One, not necessarily concentrated too much into cash, right? And the 60-40 is basically alive and well, and it has done incredibly well in 2023, up almost more than 15%. So actually, for long-term investors, that's probably is a good strategy to go back to. So think about diversification, think about balance, especially for investors that may have more of a long-term goal, but they're not looking to outperform a benchmark on an annual basis.
Roger, thanks so much for joining the show today. We appreciate your time and insight.
Absolutely. Thank you.